What's up, guys? I'm Mike from StockedUp. In this video, we're going to be going over what happened in the market today, what I see for next week in the market, and a very important lesson to learn when trading volatile times like we saw this week. So a lot of great lessons to be learned in this video. Make sure you stick around to the end. We're going to get right into it. So the market, if it was, it's down a little bit today. It's down like 300 points. About 350 points, gap down, obviously fell a lot and then ran back up. But the main thing I am looking at is you guys have to keep in mind that this week alone, the market fell 4,500 points. So the thing is we've had 1, 2, 3, 4, 5, 6. We've had 6, and then if you count today, 7 red days in a row. 1,000-point down red days. The market has to pull back. It's just how it works. But here's the thing: the market, the implied volatility is extremely high right now. So, like, if you buy the wrong options, you can be right on, your prediction, but still lose money. And I'll show you what I mean right now. So, for example, every single stock that you can pretty much find in the market right now, especially blue chip stocks and like the SPY, the options are overpriced. They are overvalued. Look at the implied volatility. It is sky high. So Apple was down today. It was down a little bit, but look at Apple's options chain for today. All of the calls are down. They're down 99%, 96%. The in the money ones are even down 20%, 15%. And then the puts are also down. I mean, they pretty much all lost value except for a couple of them that are pretty far in the money. But if you pick the wrong options, your options are going to start to look like this, even if you pick the direction correctly. And the way to protect yourself from these situations where both the calls and the puts lose is to trade a form of, it has to be some type of spread. So preferably a credit spread when the implied volatility is high. So for example, if you think Apple's going to go down, it wouldn't be smart to buy puts. It would be smart to sell call credit spreads. If you think Apple's going to go up, it wouldn't be smart to buy calls. It would be smarter to sell put credit spreads. Now, with the market right now, I'm really looking at the VIX. So the VIX is just exploded. Pretty much when the market goes crazy and there's fear in the markets, the VIX goes up. So this moves a lot. I'm looking at puts for the VIX for next week. We'll see what happens, but any sort of good news or any sort of bounce up will have the VIX fall. And when the VIX falls, it falls hard. So, and also what I like about the VIX is the VIX, the VIX, what was it? VIX 20, what is it? 03, 06, put, what is it, 21, I believe? Yeah, so right here. So these are the VIX 21 puts that expire next week. So they're 21 puts. They're relatively close to the money, but someone just bought 20,000 of these today. So they bought 20,000 puts for $85 each. So 20,000, 1, 2, 3, times $85 each, $1.7 million in VIX puts. That expire next week and that are out of the money. And these are already up. So they bought them for $85. They're already up to $135. These are a solid play too. Definitely looking at that. And another thing I really like is, you see a lot of people putting, for example, $1.7 million on an out of the money option that expires next week. And you also see big institutions selling far out of the money puts. So, like, for example, on Apple, if you look at like the 260 puts that expire next week, you have 13,000 of these contracts traded, and it's at $531 each. So, that's $7 million worth of volume. And, it's not like, the smart money is selling this right here. The smart money isn't buying in after it just went from $27 to highs of $1,350. They're shorting that. The options are overvalued. So any sort of pullback, any sort of bounce up, even if it's temporary, will absolutely kill the put options, especially in the SPY, in Apple, and AXP, and all these Dow stocks. They're so overvalued right now, and any little pullback is really going to just kill those contracts. So the biggest takeaway is, whether you think the market's going to go up or down or whatever, you have to play the plays correctly. So you can buy puts. Today's Friday and the market could be down Monday and you could still lose money, and that's because of everyone's expecting a move. Like, the implied volatility is so high, and everyone knew that options are so overpriced that it would be smarter to like sell call credit spreads. So that's my 2 cents for the market right now. Just any sort of little pullback will absolutely kill put option pricing. I like the VIX for puts, really. I mean, really what this is like, if the SPY does nothing, or if it just like bounces up a little bit, the VIX is going to sink, and it's a great play. The VIX options are expensive too, but if you just have to get close to the money. So that is that. Let me know what you guys are looking at for next week in the market. Thank you guys for watching to the end. Feel free to subscribe, and thanks for watching.